Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Justin Smith. Justin serves as the Director of Construction for a global construction and development firm where he directs the successful development and construction of student housing. Justin is also the founder of Relequity Enterprises, a private equity and real estate firm that acquires multifamily in the Southeast and Midwest markets. He is currently a general partner on over 600 units. Justin, welcome to the show.
Tim, we finally get to connect, man. I've been trying to be on this show for a long time, so thanks for having me.
Yeah, it's definitely been way too long since we caught up, so I'm glad to have you here. Now, I gave everyone a high-level overview of your background, but on this show, we really like to get down to the details on how you got started on your journey to multifamily millions. So please tell us a little bit more about yourself and what brought you into the multifamily space.
This journey into real estate and into multifamily and into housing, all of this has really been organic and lifelong for me, quite frankly. I started off, at a young age with this desire to build city blocks, right? I think others were like, hey, I want to be a doctor, I want to be a lawyer, I want to be a psychiatrist or a physician or whatever the case might be. But for me, it was like this dream of building objects, building buildings, building, structures and downtown buildings and things like that. So that desire kind of pulled me through the architectural school and the construction management schools and the various degrees in that space, as well as the real estate finance degrees and things like that I've acquired over time, with this really base desire to understand how to build a city block. So, and I've just followed that path, and it's been something I've enjoyed. I can walk around various cities and kind of point to, hey, I did that building, or hey, I own that, or hey, I sold that, or whatever the case might be. And I take pride in that.
Yeah, that's great. You talk about how it started even when you were young. You were playing with the Legos and you're like, I want to turn these into real buildings. Then playing Monopoly and you're like, hey, I want to build those apartment buildings. So no, that's good to hear. Tell us a little bit more about your career and what did you always start out on the construction side of things? And if so, how did you start out and where has that led you to now in terms of the type of construction and development that you're overseeing and make happen?
Yeah, yes, I did start off on the construction side of things because in my mind, I really needed to understand how things were built, how things came together, like a foundation in concrete. Well, where does that come into play in the process? Building walls, having mechanical systems, having electrical systems, putting a roof on a building. And then putting massive roofs on buildings and cladding systems and all of these different things. In my mind, that was where I saw the start of it being. What I quickly started to also learn is that there's this major piece called the finance piece, right? That really starts off in an Excel spreadsheet somewhere or some other computation or basically a pro forma. And I realized I had to adapt sort of this thinking of, okay, well, I'm just going to go out and build it to, oh, well, I need to first finance it. And I need to find debt on that deal. Oh, I need to find equity on that deal and putting those things together. So for me, it was yes, starting off in construction, moving into the finance and the pro forma basis of things. And then from there are other nuances that we all may be familiar with. Like there's the finding equity partners, dealing with those equity partners, asset management, property management, capital raising, right? And all these sort of offshoots of the pro forma, offshoots of that financial piece that I really had to start to dissect and get a grasp for. But whether it was construction, whether it was finance, whether it was asset management, property management, my whole thing was learn by doing. So it took me a little bit longer to do some of these things because I wanted to do it. I wanted to feel the pain. I wanted to have skin in the game, as they say, right? I wanted to get out there and actually manage something and talk to actual lenders and actually talk to tenants, right? Go talk to investors, right? be an investor. And be in each one of those pieces and parts. So I really truly had appreciation for how things work. We're in a business where it, you, you, in many respects, you have to do it. And that's from our perspective. You have to really understand the tangibles, the intangibles, the unspeakables, and then forecast and plan for the eventualities, both positive and negative.
Yeah, and I think you hit on a couple of important points there. First is just that there's so many different segments to this
Hmm.
business that
Hmm.
it's really hard to be an expert on all of them.
That's right.
You but you need to be familiar with what they are, the influence that they have on any. And so obviously you have a distinct advantage in what you do from the construction side, because that gives you purview into how a building is built, and then also from the ground up side, how it's financed from day one versus just buying it, holding it, renovating it. But the other piece that you talked about is that learning by doing. And I think that plays into the fact that there's so many different facets of this business, because you decided that yes, the training is important. Going
Hmm.
through these classes, getting mentors, that's all important. But if you don't execute on any of that, then if you don't try to do the things that they're telling you need to do, then it's really hard to internalize any of the stuff that you're learning. Um,
Right.
and
It
and you
really
also
is.
and you also get like the nuance, I guess, would be the point, right? It's that whole when the rubber meets the road thing. Like you can learn,
Mm.
but as we say in the military, like no plan survives first contact. You can make this plan, but as soon as bullets start flying, like things change. The
Right.
situation can be different. So I really like the fact that you wanted to not just learn it, but do it. And you talked about being a passive investor. And I think that really gives you unique understanding into the considerations of what passive investors are looking for and what their
Right.
concerns
Yeah.
are. Would you say that's true?
I would. And it's interesting because I don't think I've ever been a passive investor in the truest sense, because my first property I went out and I purchased. It was a single family, but I purchased it right. And this was in the fix and flip days, and I decided, hey, instead of flipping, let me just buy and keep, or fix and hold, or whatever the case, whatever the soup du jour term is. And I just held on to it, and then started to really understand. And then the next one was a multi-unit deal, right? And really start to understand the nuances of being an investor. And hey, passive income, mailbox money, oh, that sounds great, and this and that. Well, what happens at 1 a.m. on a Sunday night when someone calls you and says their water heater burst or whatever, and you get that call, right? Not the most opportune time to get that phone call, nor what you want to hear. But, as an active investor, that's the call that you might get. As a passive investor, you may not. Yes, that's a mild war story, but it truly tells the story of learn by doing and learn by about how you build your business, or how you build your real estate investing practices to ensure away from those things, right? And having those experiences, helps me be a better steward of others' capital. Because if I'm raising on a deal, all right, and someone says, hey, well, how are you going to be a good steward of my capital? What have you, and essentially what they're saying is, what have you done, right? And who have you done it with? And have you gone full circle, right? But it's a very simple question. You need to be able to convey that sense of confidence, that sense of trust, right? That you will steward their capital in a manner that's consistent with their wishes and desires. Because hey, they know, like, and trust you. So you need to be responsible in that case. So having those experiences puts me in command of that responsibility.
Yeah, and I think the other piece too of trying these things out and having those experiences, it's valuable in another sense in that it tells you what you enjoy doing, right? Like there's all these different aspects to this business, and someone may love jumping into spreadsheets and doing
That's
that
right.
underwriting because it's more in line with just their strengths, their desires. But that ain't me. and that's okay. There's other aspects that I do enjoy. I do enjoy talking to people. I like dealing with the property managers, finding
Hmm.
ways to make running that business more efficient, because that's, I think, the important part for people to understand. These are not just apartment buildings. From our perspective, they are businesses. They are valued as such, right?
Hmm.
They are
Hmm.
valued based on how much income they produce, and that's
Right, right.
based on, you know, reducing costs and increasing income. So
Hmm.
I think it's really valuable for people to at least look at these different facets and maybe try them out if it makes sense, so that they can learn not only more about the business, but learn how they want to participate in the business as well.
Yeah, I think that that's really important understanding. You tapped on a key piece in understanding where the revenue, and I don't know if you said this, but where the revenue comes from and understanding that tenant base, right? And what that truly means and how you affect their lives and how you influence their lives and make their lives better. That's one thing I took away from what you were just mentioning. And then the second thing is knowing your strength. It's okay to say, I don't like spreadsheet. It's okay to say, I don't like talking to other people on a very direct basis. Maybe you're not, maybe you what extrovert, introvert. We're all these different types, right? And understanding your strength and playing to your passion will make you a much more successful, I think, person, business person, your co-investor, co-GP, GP, whatever, because you know how you play and what you play in that piece in part. And that's unique and that's genuine.
Yeah, and we talked about this a little bit before, but based on your background doing construction and development, I would assume that it gives you a unique advantage again
Mhm.
in acquiring multifamily properties, or even
Mhm.
doing like those ground up development projects. Do you feel like that's true? And if so, how have you seen that manifest?
Well, I do feel like it is true. And let's look at it from either a construction or development perspective. Let's say on a development project, your interest rate changes. And so that interest rate is based on the project value or the project budget. Having the experience within construction and having construction, a pre-development, and even design, having that experience, you can go back into that budget and look at the biggest piece of that budget, which is typically your hard cost, and go back to your drawings and have that conversation with your general contractor. How can we reduce this budget? And having that experience, I can go and say, okay, what type of cladding systems do we have? What type of windows do we have? What type of HVAC systems do we have? What's our cost for concrete? What's our cost for wood? Let's say it's a type 5 project. How much are we spending for wood? How much are we spending for framing members and those type of things? So being able to go back and break down those divisions, because construction is typically broken into different divisions like plumbing, conveying systems, electrical, finishes, and that type of thing. But being able to go back in there, I think that my experience very carries that weight in that regard, right? Because I can go back to a construction budget and take a look at it and say, okay, here's where we may need to trim some fat, or understand that maybe there are other areas that we need to take a look at outside of that if there are no areas there. So that's on the construction side of things. And I think on the acquisition side of things, having done renovations, commercial buildings, mixed use buildings, properties, multifamily properties, single family properties, and things like that, and kind of looking at, okay, what is the overall target that we're trying to achieve? Are we trying to change the outside of the building? Are we trying to change the inside of the building? Are we trying to change our tenant mix? And so understanding what that goal is, then you can look at that particular and say, okay, well, let's change the cladding on the outside. Maybe the interior is okay. Let's change the roof because there's some waterproofing issues there, but the interior is okay. So let's just do the roof. Maybe it's a fix and flip where, you want a quick turn, as some say, put lipstick on a pig, if you will. And maybe it's just curb appeal, right? Maybe it's just your landscaping and adding trees and paying your trim. And so I would say that having that construction experience, both in the retrofit as well as the new construction arena, kind of helps me be able to manage the pro forma in a sense that makes that help make that more profitable.
Yeah, and that's what I figured would be the biggest benefit, especially
Mhm.
for the more traditional value add type play, you can go in there and look at the capex and say, okay, you got to replace 30 roofs, and you may not be able to give an exact amount, but you have an idea at least,
Mhm.
whereas some others may not. And you may also have those relationships to where
That's right.
you can get that work done. And that could be almost more important and more valuable nowadays when we're running into issues where we can't find the people to get the work done. We can't get the
Mhm.
supplies necessarily because of supply chain issues. So,
Mhm.
is that
Mhm.
something that you've run into before where you were able to leverage the relationships that you had from your regular construction business to, say, like a renovation on a project that you were working on just purely as an investment?
Yeah, I would say so. One particular example is having relationships, because I do a lot of student housing, right? And student housing, they're very they're very schedule intensive. And whether it's on the acquisition side, they can be schedule intensive because you have certain windows of time to make the project or to renovate the project, or on the new development side, you have a finite window that deliverable date that you need to hit. So having partners, whether it is partners that can do your framing, whether it's modular partners, whether it's furniture partners, whether it's design partners that understand that model, and having done that in 2 and 3 and 4 different states, I can bring those same partnerships to a particular deal. Right now, we're looking for shovel-ready student housing deals. So if any of your listeners have a student housing deal that they may have the drawings done or may have the entitlements done and looking to take it to that next level, definitely, and looking for a partner in those ventures, give me a call, because we have a lot of partnerships. We have the vendors, we have the relationships with designers, and we know sort of the formula, right? And we can help bring that project to life from that perspective. And then the same goes for acquisition. If some of your listeners have student housing deals and they're trying to either look for GPs or co-acquire, or then we can also help out in that regard. And we're definitely looking for those type of opportunities.
No, that all makes sense. And you mentioned, what is the goal
Mhm.
when you're looking at the costs involved, and I think what that can also how that can be restated is what is the business plan,
Mhm.
because the business plan for that property is really going to drive what you need to do in order to reach that goal, right?
Mhm.
And a lot of that is going to be that's going to drive a lot of the costs itself, whether, like you said, it's a light value add where you're just
Yep.
sprucing
Yep.
up the outside, or whether it's a heavy value add and you got to gut some things. That's going to
Mhm.
be dictated by the business plan that you have. And so
That's right.
as long as you understand that, you're going to be able to say, okay, well, if that's the case, then you're going to need to do this, this, and this, and it's likely going to cost this much, which is just hugely important with regards to figuring out the overall budget and therefore the returns for that deal.
Yeah. I would agree with that with respect to, you said something key, know your goal, right? And that really gets down to, yes, understanding your business plan, which is key, but then at the base of that business plan, you need to know your exit strategy, right? And that goes really hand in hand with the goal, right? What's the goal of this particular deal? A, and then B, what's the exit strategy of that deal? Because that's where the goal is usually aligned, unless you have a more intangible goal. But that's really where the goal is usually aligned. Is like, okay, what's this exit strategy? What's the way to, if I'm promising a certain cash on cash return, or if I'm promising a certain IRR, then that's the goal. And built within that goal is an exit strategy that allows you to achieve that goal. And that needs to be known from day one. Going into that deal, knowing exactly how you're going to exit, knowing exactly what the goal is, and knowing exactly how you, getting back to who you are and what your passions and what your backgrounds and that, knowing where you are going to play in that process.
Yeah, and I would say not just having that one exit strategy,
Mhm.
you should have your goal exit strategy. This is what we want to do.
That's right.
But
That's right.
I think a lot of prudent sponsors, GPs, whatever we want to call them, they'll have a couple of exit strategies on there to show that they're thinking through those worst case scenarios, to say,
Mhm.
hey, if the market acts the way that we predict it's going to, then we can sell in year 3.
That's
But
right.
if it doesn't, what we can do is refinance and sell in year 5, and we already have the lending in place to do that. And so it shows like just another level of due diligence on the side of
Mhm.
that sponsor to
Mhm.
say,
Mhm.
hey, I'm not just looking at this with rose-colored glasses or whatever the analogy is. Like everything's going to be rainbows and butterflies. I understand that this market changes, but
Yep.
if it goes down to this, then we already have a plan for that, and we will still hit these returns. Those returns may not be as high as the best case scenario, but at least
Mhm.
you have that other exit strategy if your primary does not work out well for you. And I would say even further than that, like nowadays, just as important, or if not more important, is the cap rates on exit that
Yeah.
people are looking at. Before it was down, down, down. Like, hey, don't worry
Mhm.
about the cap rate. It's going to be good. But now we're having to put in there like sliding scales of, hey, if the cap rate gets to this, then this is what your returns will be.
Mhm.
But it'll still be okay. So
Yeah. Yeah. No, you're right. A funny thing about what you're saying, but in the last, I'd say 3, 4 years, low interest rate has made a lot of people a lot of money, but more importantly, it has made a lot of people look good. Like, I mean, it's been like, oh yeah, we went 4x, or we cycled out of a deal and we this and that. Well, in a low interest rate environment, I'm not going to say that's easier, but that's easy to do rather. But it has made the process easier in terms, because buying numbers, your bridge numbers are better and that type of thing. But now we really got to get creative. You can't just throw a bunch of money at a seller, or if you're a buyer, you can't just roll in with low cost debt and just make a deal happen, right? You really got to look at your yields. You got to look at your interest rates. You got to look at your exit caps. You got to look at your reversion cap. You got to look at your going in cap rates. You got to look at all these different metrics and really fine tune what you're doing, because money is not cheap anymore. So it's really made people either walk away in some cases, and in some cases it's made people really sharpen their pencil and get really strategic about being stewards of investor capital and their own capital.
agreed. Yeah, and I think I don't know. For a little while, I felt like everyone was a multifamily investor, but just like the house flipping days when it seemed like
Hmm.
everybody was flipping houses, I think
Hmm.
there's ebbs and flows to that, and I think right now that crowd is probably going to shrink a little bit now that it's not necessarily as easy as it has been because,
Hmm.
like you said, a great market, everybody's a genius, right? Same with
Right.
stocks. It's same with this business,
Yep.
but I think Warren Buffett says like the guy who's not wearing a bathing suit as soon as the tide goes out, like there's gonna be some people where they're not wearing a bathing suit right now when they aren't able to refi, for example,
Hmm.
at the rates that they expected to.
Expected
Once
to. That's right.
once that interest only period is over, they're like, oh yeah, we might need to relook that exit plan that we had
Hmm.
coming up
Hmm.
here. So it'll be interesting times, I'd say, for the next year or two. I think things will settle down a bit, but the next year or two, things are going to be a little shaky.
Yeah. Yeah. And I would say to your listeners and to your guests that there is still always an opportunity to buy, despite what's going on, despite interest rates, despite all these different things. It is still a good time to buy assets. You just have to figure out how to do it in a meaningful manner that achieves your goals and your objectives. And if that means that you don't buy or you say no, then you say no. But nevertheless, you can come up with more creative ways to approach a deal, and you may have to sift through 200 deals to write a LOI on 3, right? And if so be it, but you have to stay disciplined. You have to know your exit strategy and set appropriate goals.
Yeah, and I think I 100% agree with all of that. And that staying disciplined, I think part of that too is just not letting your emotions rule
Yep.
decisions.
Yep.
And I think in times like this, a lot of investors, both passive and active, get a little bit paralyzed by fear, which is is a normal human reaction.
Hmm.
Just like if you have all your money in the stock market, it starts to go down. Logic would tell you to hold on, it'll go back up, but that's not what happens.
Hmm.
People sell at the worst times because of
Yep.
that fear takes hold, and they can't let their better senses stop them from doing that. But people, wealthy people, people who have made a lot of money in investing, they're always investing. Like you said, they don't stop investing for one period then start again when they think the market is better, because regardless of what the market looks like, you're absolutely right, there are always opportunities. Does it become
Hmm.
harder to find those opportunities? Perhaps, but there's always opportunities out there. And that's why I would tell people, again, probably the worst thing you could be doing right now is just leaving your money in your savings account where it's eroding from whatever 9% interest, whatever it is, or 9% inflation, whatever it is today, right? Well, this has been some great conversation, but we do have to move on to the turbo round. All right, Justin. So I'm going to ask you 3 questions that I ask everyone who comes on here, and I want to get your quick, honest answer. So the first one, what is one red flag that every investor should look out for? And that could be either a passive or active investor.
The words "get rich quick." So I just say, if you're in the multifamily or the real estate business, get rich quick is synonymous with some other industry. But I'd say it's a red flag. I mean, I'm not saying that there's not an opportunity to benefit or to gain economic advantage or to gain some particular return on something, but just know that there is a time value of appreciation associated with real estate. And then that usually requires you to add some element of value add, or some investment strategy, or some interest rate, or some debt or equity strategy, or whatever the case might be. So get rich quick is probably not one, it's probably one thing that you should know is a red flag.
Agreed. When you say that, it makes me think of like 2 a.m. infomercials with a guy on a boat.
You're right.
Saying how he can make you a millionaire in a week. But realistically speaking, you're right. I think investors need to understand that it is not a get rich quick business, and that it's more like a marriage. Well, hopefully not exactly like a marriage, because most marriages I would hope would last longer than 5 to 7 years. Point being, it's a long-term relationship. And so you're going to be with that investor for anywhere from 3 to 7, in some cases even 10 years, and you're committing to that investment for that period. And you shouldn't really expect to get your money back during that time if it's illiquid in that sense. Now, can exceptions be made? Sure. But again, go in with the expectation that you don't get that money back, but with the goals that over that time, you're getting a much better return than you would on a lot of other assets.
That's right. That's right.
All right. What is a myth about this business that you would like to set straight?
Value add investing is easy. It's a myth. I mean, there are probably some truth to it, that, hey, it may be easier than other forms, but it's not really easy. I mean, I really do think that you have to look at what it is that you're value adding. What are the underlying circumstances? Is the building vacant? Is the building 100% occupied? Is it 70% occupied? Is it in a urban area? Is it in a rural area? What materials do you need for that value project? What contractors are available? Is everyone busy? How many cranes are in the air? All these different circumstances from a value add perspective can change the ease of it. But don't go into it thinking, hey, it's just easy and you can go in and paint the walls and fix the roof and change the windows, and boom, all of a sudden you're going to be cash flowing tremendously, right? There's circumstances associated with that. So I would say is the myth. So just be advised, it's not super easy. It's not just regular easy, but there are circumstances that can make it easier, but just learn by doing and get in and do it.
Yeah, I couldn't agree more. And I think some people almost think of it as a fix and flip, just on a bigger scale. And it's not quite that simple. Again, we talked about just some of the considerations involved, and all of those things play into how profitable that property will be and what needs to be done to get it to that level of
hmm
profitability.
hmm
So
hmm
you're absolutely right. This is not a fix and flip with 150 units. It's a little more complicated than that. And again, that goes to investor expectations, right? Like they may not even see a distribution in the first year if this is a heavy value add, because
hmm
guess what? We're doing a lot of construction on the property, and maybe it's not leased up to where it needs to be, or going into it, it's only at 50% occupancy. Well, okay, it's
hmm
going to take some time to even get to break even, let alone to a level of profitability where we can start kicking that off to investors. And as long as they understand that up front, like, hey, it'll be 1 year, it'll be 14 months before you see that first distribution,
hmm
then I think
hmm
everyone is happy. It's just making sure that expectations are met. And that's a big responsibility for us, I think.
Yeah, yeah, true indeed. True indeed. It is a big responsibility.
All right, so the last question, what does success look like to you?
What success looks like to me is achievement of my plan and vision over a defined period of time. That's what success is for me. Achievement of my plan over a defined period of time. What do I mean by that? Because I keep my plans and I keep my vision on my wall. I keep my goals on a whiteboard in my office, right in front of me. And I put time and days and dates and targets in that. And by hitting those targets and by hitting those goals, I call that success. Because then I actively place a target, actively create a goal, and then I watch it every day. And then when that date comes, and if that goal is December 31st, and I look up at that goal and it's December 31st, and I look at the clock and I've achieved that goal, that's success for me. Now, it takes a lot of work to obviously do that. And you need to do the things that you do in terms of making smart goals and making them measurable and getting up every day and making sure that you're taking the right steps to get there. But achievement of that plan over a defined period of time is success for me. And that can be very personal, right? That could be something you want to do with your significant other, or with your children, or with your life, or with a charity, or with a nonprofit, or in your neighborhood, or in your community, whatever the case might be. Setting up a plan and then allotting time for that plan to be executed, and then completing on that. That's what success is.
All right, so you did a really good job of laying out the concept there. Can we dig a little deeper and
Yes, sir.
have you share some of those goals that you do have for yourself, whether that be
Yeah,
professional or personal?
yeah, no doubt. One of the personal goals that I had was last year I wanted to achieve 1,000 units, right? So, and that's a lot, right? That's going from a divesting of certain units outside of the California market and then going into other markets. I really had to, that was a big, hairy, audacious goal. But, and getting to that goal and getting through that goal was very important for me. So I was able to achieve, I didn't get to 1,000 in that one particular year, but I got pretty close, right? But I also learned a lot along the way. So that's sort of an example of achieving my plan over a period of time. And I was able to and that was successful for me because I learned a lot in the process. I got almost 70% of the way there, but it was very productive and very successful for me.
Yeah, I think that's great. And I think it's important that people have those stretch goals, and that even
Mhm.
if they don't necessarily succeed in accomplishing all those goals, that doesn't mean you need to
Mhm.
beat
Mhm.
yourself up. Because did
Right.
you grow as a result of those efforts? And if
That's
the
right.
answer is still yes, then that's a piece of success too.
Yep. Exactly.
All right.
Exactly.
All right, Justin. Well, hey, this has been great. Please tell our guests how they can get a hold of you, and if you have anything else that you would like to share with them.
Yeah, how you can get a hold of me is through my website, REL Equity or Relequity, RELEquity.com. You can also reach me via email, info@relequity.com, REL Relequity.com is the best way to reach me. Or I'm on LinkedIn. I'm also on Instagram. The same thing. Relequity is the at Relequity on both LinkedIn and Instagram are the other social media presence that I have there.
All right, awesome. Well, we'll definitely have all that information for the listeners in the show notes. Justin, it's been awesome having you on. We'll definitely have to have you on again after you've hit that big, hairy, audacious goal of 1,000 units, so you can tell us all about how you got there. But in the meantime, we look forward to seeing you do big things on your journey to multifamily millions.
Thank you, and thanks for having me, Tim.
Absolutely.